All right, this is our final learning objective for the chapter, and now we're moving into special situations. We're going to start with some very common situations, and that is stock sales. One thing to understand right away is that investors usually don't buy all of their stock at once. Instead, they might buy shares at different times and at different prices. What we call different blocks of stock. So when they go to sell some shares, we have to answer an important question. Which shares are they actually selling? Because that determines the basis and that directly impacts the gain or loss. There are two main methods used to figure this out. The first is called specific identification. This means, just like it sounds, that the taxpayer actually identifies exactly which shares they are selling. For example, I'm selling the shares I bought in January, and I know exactly what the cost was at the time I bought them in January. The second method is FIFO, which I'm sure you're familiar with this term by now, which is first in, first out. The taxpayer doesn't specifically identify the shares. The IRS assumes that the first shares purchased are the first ones that are sold. So those earliest purchases become the basis used in the calculation. So the big picture here, same stock, but different purchase dates and prices, and the method used can change the gain or loss significantly. All right, let's stay in the investment world, but now shift from an individual stock sales to mutual funds. A mutual fund is essentially a pool of money from many investors that's used to purchase a diversified portfolio of stocks or other investments. So instead of buying individual shares yourself, you're investing in a fund that holds a mix of assets. Now, at the end of the year, investors don't just report sales, they also receive a form called 1099 DIV. This form reports things like dividends, capital gain distributions, and other distributions from the fund. And here's an important point. Even if the taxpayer didn't sell anything, they can still have taxable capital gains. That's because mutual funds often buy and sell investments internally, and those gains are passed through to the investor as capital gain distributions. Now, in terms of reporting, these amounts are typically reported on Schedule D, but if the taxpayer has a very simple situation, meaning no other capital transactions, those capital gain distributions can sometimes be reported directly on the 1040 instead. So the big takeaway here is mutual funds can create taxable income even without a sale, and that income shows up on Form 1099 DIV. Now let's take what we just discussed and go one step further, because determining the basis for mutual fund shares can actually get a little tricky. That's because just like individual stocks, mutual fund shares are often purchased at different times and different prices throughout the year. So again, we have to answer which shares are being sold. For mutual funds, there are three methods the taxpayer can use. The first is FIFO, first in, first out. This assumes, again, the earliest shares purchased are the first ones sold. The second is specific identification, where the taxpayer actually identifies exactly which shares are being sold, just like we talked about with the individual stocks on the last slide. And the third, and this one is unique to mutual funds, is the average basis method. With the average basis method, you essentially combine all the purchases, calculate an average cost per share, and use that average to determine the basis of the shares sold. Now, many mutual fund companies will actually calculate and report this average basis for you on your annual statement, which makes things a lot easier. But here's the key rule. Once a taxpayer selects a method, they must use it consistently going forward for that specific mutual fund. So they don't get to switch back and forth during the year depending on what gives them the best tax result. Once you pick a method, you need to stick with it. Big picture here, multiple purchases create complexity. And the method chosen directly affects the gain or loss reported. But again, that method that you choose, you need to stick with it for the life of that fund. All right, let's talk about a situation that can feel a little strange at first, and that is worthless securities. This comes up when a taxpayer owns stock that essentially becomes worthless, meaning it has no value left. Now, instead of requiring an actual sale, the IRS treats this as if the taxpayer sold the asset for zero. So proceeds from sale, zero. And here's the key rule. The sale, quote unquote sale, is considered to happen on the last day of the tax year. So even though nothing was actually sold, we treat it as a capital loss, and the holding period still determines whether it's short-term or long-term. Now, one thing students often assume is that if a company files for bankruptcy, the stock must be worthless. But that's not necessarily true. A declaration of bankruptcy by itself is not enough to claim a loss. The taxpayer has to be able to show that the stock truly has no remaining value, which sometimes doesn't happen until later. And that leads to another challenge. It's often difficult to pinpoint the exact moment when a security becomes worthless. That's why the IRS simplifies things by saying, just treat it as becoming worthless on the last day of the tax year. So wrapping up again here, the big picture, for worthless securities, no actual sale is required. It's treated as a capital loss, and it's always deemed sold on December 31st of that year. All right, now let's talk about another situation that can get a little tricky, and that's when property is received as a gift and then you turn around and sell it at a later time. The challenge here is figuring out what basis do we use to calculate the gain or loss, because now we have two possible numbers, either the donor's adjusted basis or the fair market value at the time of the gift. So which one do we use? And the answer is it depends. So let's start with the easier situation, and that is the fair market value at the time of the gift. So if the fair market value at the time of the gift is greater than or equal to the donor's basis, then the rule is simple. We just use the donor's adjusted basis for both gains and losses. But if the fair market value is less than the donor's basis, things get more complicated. And this is where students usually get tripped up. Now we have a dual basis system. So for this, we're looking at use the donor's basis if we're calculating a gain. Use the fair market value if we're calculating a loss. So that's really important. And then there's one more wrinkle here, a special rule. If the selling price falls in between those two numbers, meaning it's above the fair market value but below the donor's basis, then there's no gain and no loss. So the way that I like to think about this is higher number used for gains, lower number used for losses. In the middle, no tax effect. So yes, this is one of the few areas where basis depends on the outcome, which is why it really feels backwards at first. And again, this is so complex. Please, I want to hear from you all. If you want me to walk through an example on this one, I am more than happy to do it. If you want me to look at an example in your homework and say, let's see how this one plays out in practice, just let me know. I'm happy to do it. All right, let's finish this section with one of the most favorable rules in tax, and that is inherited property. When a taxpayer inherits property, the basis is generally the fair market value at the date of death. There's also something called an alternate valuation date, but that's only used in specific estate situations and only if it actually reduces the overall value of the estate. So for now, for our purposes, just remember inherited property gets a stepped up basis to fair market value, or step up basis to fair market value. Now, here's another big benefit. The holding period is always considered long-term. So it doesn't matter how long that the beneficiary actually had the asset before they sell it, it's always going to be long-term. So let's look at an example, and this is an example on this slide. So if someone inherits property with a basis of $3,000, which reflects the fair market value at the date of death, and then they turn around and they sell it 6 months later for $4,000, that $1,000 gain is treated as a long-term capital gain, even though they only held it for 6 months. So again, your normal tendency is that your holding period was only 6 months. That's less than a year. So you want to say it was short term. However, the special exception here with inherited property is that it's always long term. So even though it was only 6 months in this example, you can treat it as a long-term capital gain. And this is one of the most favorable outcomes in tax, because if you think about it, you get the step-up basis. You're not using the basis that the person that you inherited it from was. You get a step-up basis of fair market value, and you get automatic long-term treatment. So that's very favorable on inherited property. So to wrap up this entire section, we've seen that special rules apply depending on how property is acquired, whether it's stock, mutual funds, gifts, or inheritance. And each situation can significantly impact the basis, the timing, and ultimately the tax result. Now, I want to close this out again by saying, I know that these are really complicated situations. I don't expect you all to get it without a little additional help. But again, I need to hear from you all. If you want me to walk through an example from your homework, shoot me an email and I am happy to do that. All right, I will see you all in the next video, or hopefully before that if you want me to walk through an example. Thanks.